The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. It's the Prince of Profit Season, Anthony McDonald. How are you, Anthony?
I'm fantastic, James. What a big week.
Absolutely. Well, this week we look at what the wipeout of a steel plant in Whyalla says about the economy and politics. We ask whether the bank's golden run is suddenly coming to an end, and we unpack a radical idea to shake up the mortgage market. But first, Anthony, let's start with a bit of breaking corporate news. A NASDAQ-listed online real estate group called CoStar has come for Australia's number 2 player, Domain, buying a 16.9% stake and lobbing a $2.7 billion bid to buy the rest. Anthony, this was a dramatic entry. What's the play here?
James, this one's a bit close to home to us. Domain is 60% owned by Nine Entertainment, our employer. Now, James, the play is all about this offshore group coming in to snaffle a piece of Australia's online listings market. I mean, CoStar's based in the US, makes most of its money in the US from providing commercial and residential sort of real estate information, analytics, listing sort of stuff. It's been expanding offshore. It bought a business in the UK about a year ago, and now obviously it's set its sights on Australia. Now, Domain, James, as we know, comes out of the old Fairfax media stable. It was a business that the origins of it are sort of in the newspaper and the newspaper ads. And it's the number 2 player in the market, makes most of its money charging property sellers to list their property on their website. Now, REA is the competition. It's bigger. It's been growing its listings revenue faster. I mean, Domain's listings are heavily skewed to Sydney and Melbourne. It's predominantly a 2-player market, James, and it makes sense that it's a 2-player market. Like, if you're selling a home, maybe you've been in this situation, it's worth a bit to you. You're going to put it on a couple of platforms, aren't you? So,
Absolutely.
So there's definitely there's room for 2 players in the market. Domain itself, it's gone pretty sideways for a few years though, James. Disappointed investors. I would say it's more of a badly run business though than a bad business. Like I said, there's space for 2 players still. And REA's going well, but it doesn't mean it's unstoppable. But James, Domain's the one that's in the focus here. It's the one that's got the bid, but this one's a bit close to home for us, isn't it? I mean, Domain's 60% owned by Nine Entertainment, which is our employer. What's it mean for Nine, James?
Oh, it's a big one for Catherine West, the chairman of Nine. This is a seriously tricky situation. Do you sell the family jewels and make your shareholders happy? Because the shareholders that I've spoken to on Friday morning, they're keen to get a deal done. They've always been worried about how do you unlock value in Nine. The most obvious way is to unlock it through some sort of deal around Domain. Here's the deal. And they're saying to the board, negotiate, try and squeeze a better price out, but then sell the thing, please. But then you've got to say, what does that leave Nine with? There's 2 schools of thought. Well, Nine is now a pure play media business. Everyone understands it. That's a good thing. The other view is that Nine's a conglomerate of media assets. It's a collection of assets that sort of go together, but maybe they don't. Is there a more natural owner for the TV stations? Is there a more natural owner for the radio business? Is there a more natural owner for the publishing business, which includes the AFR or the Sydney Morning Herald and the Age? So this is the sort of conundrum for West. Does she do the deal that her shareholders want, but then risk seeing Nine sort of broken up for parts? Now, I don't know if that's going to happen, but it's certainly the possibility that people are just talking about in the market. So, man, it's a real tough one. I'm not entirely sure what the answer is, but let's see where it goes.
Yeah, James, it could leave Nine as a bunch of parts plus $1.6 billion in cash, though.
Yeah, that's not too bad either. That does buy you a bit of flexibility, but Nine shareholders will want that to be straight through to the keeper, straight into their pockets, right?
Absolutely. Now, James, we shouldn't go any further without addressing the big interest rates decision. Your ship finally came in. The February rate cut you've been predicting for 18 months was actually announced by the RBA on Tuesday. Now,
Never in doubt.
Before we get to how you feel, our producers have had a bit of fun and have put together a little package in honour of your correct call, which goes back to August 4, 2023.
Right. This is absolute crystal ball stuff. The next move is down but the next move is not down until February 2025. There you go.
Wow.
I'm having a stab. I reckon rates are on hold until the end of 2024. It's because the RBA is going to look at inflation and say, hey, still above our target. They're going to look at the jobs market and say, hey, it's still very strong.
Chook Podcast has been saying for about 6 months now that the rate cuts in Australia would be delayed until February 2025. And hey, all of a sudden that's becoming close to a consensus view. I'm feeling very good about my call. But I'm getting a little worried.
I'm getting worried because more banks are moving away from my call that there's going to be a rate cut in February, aren't they?
They're definitely moving away from your call, James.
I'm still sticking with February 2025.
Consensus is definitely going towards May, James.
The CBA economics team still on the side of the James Thompson February rate cut bet. We're still alive.
I can't believe they're going down with you, James.
They're going down with me.
As you know, the board decided today to cut the cash rate by 25 basis points to 4.1%.
Oh, that's tremendous.
What a call.
What a call. Anthony, I don't know, listening back to that, whether I was stubborn or lucky or stubborn and lucky. I don't think I'm getting a job as a chief economist at a major bank anytime soon. This was a complete fluke, but look, it's nice to be sort of a bit right. But I don't know, Anthony, I didn't feel like celebrating on Tuesday, particularly when I read the RBA statement. I don't know what you thought, but this was weird. They cut the interest rate by 0.25%, and then they spent the statement and a good bit of the press conference that followed sort of apologising, explaining how uncomfortable they were, explaining how unsure they are about where the economy goes. This was a low conviction cut, wasn't it?
It was, and it was almost like the cut you're told there won't be another one coming soon after. It's a bit like when your kid's hassling you for a lolly, James, and it's early in the morning, and you're like, fine, have one. But you're not getting another one for the rest of the day or the rest of the week. You know, it was a bit like that. So
good call.
But James, like, I seriously think, like, is our landing so soft that we're cutting rates when the job market's tight and tightening, when household spending is strong and strengthening, when inflation's above target, when house prices are in nosebleed territory still, when profits are decent, when government's got the fiscal measures flowing, like this. Where's the pain, James, you know?
Yeah. Oh, the interesting question that wasn't asked, that Michelle Bullock wasn't asked, I thought was, what if in, pick a number, 4 or 5 months, the RBA has to raise rates again? Would she be extraordinarily embarrassed and feel that her credibility was demolished? Or would she say, hey, that's just what happens when you're data dependent? I'm sure she'd say the latter if that actually came to pass, but it raises a good question, I think. I mean, it's not beyond the realms of possibility. But look, history says when you get one rate cut, you almost always get another one straight after. Do you think that's how it's going to roll out this time?
No, I don't think so. But more importantly, James, what do you think? And bond traders who trade these sorts of situations, please take note.
Oh, yeah, do the opposite. I actually, Goldman Sachs economist Andrew Boakes made this argument. I think he's right. I reckon we'll get a second cut, because if you have enough conviction to do one cut, why just leave it at that? It's not going to hardly do anything to the economy. I reckon there's a chance that we will get the back-to-back rate cut, and then we might see the pause and the reassessment. But it's very hard to predict from here. I mean, I think you've said it, Anthony. The RBA tends to hold for a long time and then move. But maybe we're in a brave new world and that's not what they're going to do. But I don't know. It's a mystery. The whole rates thing, I just don't know how to read it. As I say, I've been completely lucky with my call. But where it goes now is so hard to see. We haven't seen anything in the reporting season that says there's great weakness in any part of the economy, with the exception of probably construction. So let's see where we're at. But hey, Jim Chalmers and Anthony Albanese are pretty happy about the situation. So I guess someone's happy about it. Now, Anthony, a day after that rates drama, there was some more excitement in sleepy old South Australia, where the Premier, Peter Malinauskas, made the extraordinary decision to put the Whyalla Steelworks into the hands of administrators before one day later announcing a $2.4 billion rescue package that's designed to lure a new buyer in. Anthony, what's behind this? And why are my taxpayer dollars suddenly being used to prop up failed businesses? We had Regional Express, the small airline, last week that the government's going to bail out. Now a Steelworks. Is there anything else we're going to buy?
Congratulations, James. You and your 26.5 million fellow Aussies are the new owner, or underwriter at least, of a big, expensive to run, loss-making steel mill. Yeah. How does it feel?
Oh, well, great. Particularly knowing that it's gone under now twice in about 8 years. Thanks a lot.
It's one of the two big steel makers in Australia. It's got a pretty crappy iron ore mine attached, James. So it's a bit of infrastructure. It's got grand plans, not much cash. Like you say, it's the second time in succession this thing's gone broke. And the last time it was Arium, or which used to be the One Steel, and that's when the new owner Sanjeev Gupta, this well-dressed British businessman, bought it, and there was an attached East Coast steel distribution business as well, which has lots of sites and basically sells steel. Now that's a really good bit of the business. He was very quick to sort of like spin that off and use that to help fund Whyalla and other parts of his empire. But James, this thing Whyalla, it's so political, right? Like it's funny. It's like a business that represents so much more than a business. Like it's easy to forget. Like Whyalla is a place in South Australia, about 400 k's from Adelaide. The town is the Steelworks. The Steelworks is the town. It's a big employer, 1,000 jobs. It's the main industry in the town. It's very, very political. Like you think about, these places and how they can sort of transcend politics and movements, and all sorts of decisions gets made. And Whyalla's been wrapped up in this guy Gupta's structured sort of finances for years now. It's been waiting to come unstuck, and finally the government's pulled the rug on him. They just can't keep propping it up, and they don't feel like there's a future there under his ownership. But James, this is a type of business that's very much out of favour in Australia in 2025. Yeah. You've got a big employee base, big energy user, big ongoing capital requirements. You add the carbon emissions and the transition side of this, and those things, they're just not the businesses that people want to own in Australia in 2025. So it looks like it'll go the way of a Roaring Power Station to me, or the big oil refineries, James, and whoever comes in will be getting it with some sort of government stop-loss guarantee attached to it, that if you run it, you're not going to lose money at least, and you'll be doing the country a favour. But it's just amazing that it's got to this stage again.
Yeah, it looks like BlueScope Steel, which is a listed player, is the likely buyer. But as you say, Anthony, they're going to need such huge guarantees to run this thing, huge government support. And I don't know, Anthony Albanese keeps telling us we need to make stuff in Australia, but there's a lot of cheap steel coming out of China. Construction costs are high across the economy. You wonder what future the Whyalla Steelworks really has. But let's see where this story goes. Would this have happened outside an election cycle or an election period, Anthony?
What are the chances that this goes under and the government's forcing just before the election campaign starts, James? If this happened during the campaign, there'd be all sorts of questions raised about the government's ability to run the economy and support jobs and see a business like Whyalla through.
Okay, Anthony, let's get into our first topic. And results season hit fever pitch this week with what felt like 623 companies reporting on Thursday alone, which was an absolutely nuts day. Let's jump straight in and break down some of the big themes. And it was your birthday on Thursday, Anthony, so it's your job to lead us away.
Ring the bell, James. Iron Ore's glory days are over.
Oh.
So to be fair, the bell was probably ringing a few years ago, but it's now become abundantly clear. The price was sub $100 a tonne in 2024. That was 10% lower than the year before. That means lower profits across the industry, James. The big miners, they're still pumping out the tonnes because they can mine it for much less than that. But so the volume's there, but they're just not making as much money because the price isn't there. Now, James, the big miners, BHP and Rio, we can see them, they're trying to get everyone to focus on their copper business and how they're sort of transitioning to make sure that they're more than just iron ore. they're still shipping about 300 million tonnes each year to China. While they're doing that, James, Fortescue's doing about 200 million tonnes a year. But there's a lot of pressure on the smaller miners who don't have as fat margins. They don't make as much money. Like your Mineral Resources, they're the ones that could be really squeezed out if the iron ore price gets a little bit lower. At the same time, James, you've got groups like Rio who are getting into Simandou in Africa, trying to get cheaper iron ore to sell to China there. So there's big change going on in the industry. At the same time, James, though, we had this curious case this week of Japan's Mitsui came in and spent $8 billion to buy into a Pilbara project, a Rio Tinto one.
Huge whack.
Something that's years away from paying off. And it was counter to what's going on in the industry, James. So, it was very eye-catching. That's my theme. What about yours?
Look, we saw some interesting results out of the banks this week, right? So we had Bendigo Bank at the start of the week. Then we had NAB and Westpac and ANZ as the week went on.
Yep.
With the last three had quarterly trading updates. Now, the banks have been on a golden run. We've talked about this for a long time, the incredible run that CBA's been on particularly. But Bendigo Bank, it was up 40% last year too.
Yeah, the share price.
Stunning rise. The share price had run really hard. So everyone's been wondering what stops this golden run? What could sort of bring the banks down a bit? And I think we're starting to get an answer to that question. It's not some big event. It's not some scandal. It's just sentiment shifting. And what we've seen this week is sentiment start to shift. The banks, it's becoming very clear that the banks are not growing, not really growing at all. There's pressure on their margins because the market's still competitive. And there's little hints that bad debts are starting to rise in some of these businesses. Just loan arrears ticking up a bit more. Now, none of this is new, Anthony, but I think what we've got is investors suddenly realising, hey, we've bid these share prices up so hard. Actually, things aren't that good. And so what's leading to these falls in the banks isn't some sort of shock. It's just a realisation of what investors should have known for ages. The banks aren't growing. They're not worth paying huge valuations for. And so, I don't know, to me, this is the week where that sentiment's come through. NAB, they released an okay trading update. It wasn't terrible. But what we saw was that the share price plunged 9% or 8% on a day. That's a huge move. And then you overlay interest rates coming down, which is generally bad for bank profits. Maybe we're just starting to see the start of this golden run ending. Anthony, what's another theme from the week?
Oh, so you're ringing the bell on the banks and I'm ringing the bell on iron ore. How good's Australia going?
Only the two most important things in the Australian share market. Yeah.
My other theme. All right, James, the AI boom, not over. All right. We got a whopper deal this week out of Goodman Group, who we've spoken a lot about on this podcast, James. Greg Goodman, the Goodman and Goodman Group, in his industrial property company, sheds, warehouses, business parks. It's a global leader, turning this thing into a data center developer. James, Greg Goodman's been talking about this very deliberately in his quarterly updates for a couple of years. The share price ran hard off the back of it, got investors all excited as he dripped out these bits of information. Now, this week, James, we've got a bit more disclosure about what Goodman's actual plans for these data centers are, the sites, where they're going to be, how much power they'll take up, all that sort of stuff. And they told us they're going to use 1/10 of their power bank to build data centers that would be worth $10 billion.
Yikes.
Right?
1/10.
1/10. So they're telling us they're sitting on $100 billion of undeveloped data centers, should they ever be developed. So it's a big number, James. Now, to capitalize on this excitement and the big reveal, to fund it all, they raised $4 billion in equity in one day. Now, James, that's a lot. This would be the 6th or 7th biggest ever equity raising on the ASX. It's a whopper, the biggest one in more than 3 years, the biggest one ever in the property sector. It's a huge deal. Now, it was very interesting, James, because Goodman Group and Greg Goodman himself, he could have funded this with debt. He could have funded it with private capital partners. He could have got Australian Super or a Singaporean Sovereign Wealth Fund or someone else to come in. But instead, he chose to raise equity, which is usually the most expensive form of funding. And why? Well, Greg Goodman and Goodman Group, they pretty much went broke in the GFC, James. And Greg Goodman's rebuilt this thing into a bigger, better, stronger $70 billion powerhouse. It's now big in industrial property. He wants to go big in data centers. He ain't risking the farm this time. He's raising equity to do it. And I actually took it as a big affirmation in public equity markets, James, that, for all the heat and all the push behind private markets and private capital, when you've got someone that's actually willing to use public markets and knows how to use them properly, they can be hugely powerful and can help you with something like such a big, ambitious growth project.
Anthony, I'm glad you mentioned Goodman because we love questions here on the podcast, and we've actually got an audio question from Derek from the Blue Mountains on this very topic. So let's go to that now.
Hi, Chanticleer. Love the show. I was keen to get your thoughts on the upcoming Goodman Group equity raising and whether it's worth participating in, and also what your outlook is for the REIT sector in general, such as Vicinity and Centre Group. Thanks, Derek from the Blue Mountains.
Well, Derek, we can't give you any specific financial advice and of course everyone will have to think about their individual circumstances. But Anthony, just give us a quick comment. Is Goodman Group going to have any trouble raising this money?
All right, so there's two bits of Goodman's raising. It raised $4 billion this week from institutional investors, and now it's going out to its retail investors and trying to raise up to another $400 million. That's what Greg will be talking about. So each shareholder is going to be offered to buy, I think it's up to $30,000 worth of shares at $33.50 a share, which is the same price as institutional raising.
I might take the second part of the question about the outlook for the REITs, Anthony, because that leads into my other big topic for the week. We're all talking all the time about the housing shortage, right?
Yep.
We can't build enough houses. Construction costs have risen, sent prices through the roof. Affordability is crappy. But there's actually a couple of other shortages in the property market that are really becoming obvious. One is office property. We're seeing that there is not enough new office property being built in the core parts of Sydney, the core parts of Melbourne where tenants actually want to be. So in Sydney, we've talked about this before, it's a sort of golden rectangle between Martin Place and Circular Quay. In Melbourne, it's the core of around Collins Street and Burke Street up the top of the end of the city. So there's not enough office property being built. 50% of what was built in the last 5 years is going to be built in the next 5 years in Sydney. So if you're an office property owner, you've had a couple of tough years, but the view is it's starting to get better. And the retreat on work from home certainly helps that a little bit. But we're also seeing a slowdown in the number of shopping centres we're building.
Yeah.
Despite all this population growth we've had, there's just not many shopping centres going to be built. There's not many in the pipeline between now and 2030. So we're also seeing another shortage there. So the property REITs have had a pretty tough period, in part because of valuations, in part because of high interest rates. But there is, Anthony, an argument that they're starting to see the bottom and they could be coming into a period of recovery. Just quickly, we've got one more week of reporting season to go, but what's the company you think you'll be keeping an eye on coming out of this season?
Mineral Resources, James. The iron ore mining services group. It's got heaps of debt. It's getting pinched in iron ore and lithium. It's two big commodities, and it really is a white knuckle ride there. What about yourself?
National Australia Bank had a cracking run. I think the shares were up, about 25% last year. Had this big dip now. Is there? Do they sort of adjust their strategy? How do they react to that? I think it's a bit of a bellwether for the banks. They've been the big comeback story in the banking sector. I think everyone's looking at the banks now. How do they go? And NAB will be one that gets plenty of scrutiny.
Okay, James, let's move to our second topic. Now, one of the best things about our job is that we are privileged to hear from some of the heaviest hitters in global finance who come to Australia to visit the kingmakers in our $4 trillion superannuation sector. James, on Thursday, you got to sit down with Larry Fink, the billionaire boss behind BlackRock, which manages $18 trillion of assets and was one of the pioneers of exchange-traded funds, which are the passive investment vehicles that allow investors to track entire share market indices rather than having to pick individual stocks. Now, James, let me just explain it. For those that don't know, BlackRock's a bloody huge deal in global financial markets, and Fink's a huge deal and he wanted to come meet the big chook. Larry arrived with a very, very big idea that could change the Australian housing market and in some ways, James, the economy. Please tell us, what was it?
Well, he wants me to set interest rates from now on. No, I'm kidding.
You already are.
Fink's idea is really interesting. So most of the home loans we have in here are what's called variable rate loans. So the reason that everyone pays so much attention to what the RBA does every 5 minutes is because homeowners loans get adjusted almost immediately on what the RBA does. But in America, where Larry Fink's from, it's totally different. The predominant form of mortgage there is a 30-year fixed rate mortgage. Mm-hmm. So what you do, you buy a house, you take a mortgage at 7% for argument's sake, and you've got that for 30 years, unless you see mortgage rates going down, in which case you're fully entitled to refinance, take advantage of the lower loan. So this is a big idea. And what would it mean for the consumer? Well, I guess you get certainty. You get to lock in your home loan rate for 30 years with the ability to reduce it over time. You can plan, you can figure out your expenses, you can do those great spreadsheets and have that certainty that you know what your home loan repayments are going to look like.
Yeah, it removes the interest rate risk.
And that's the complete opposite from what we got now, where, you know, your repayments rise and fall with every decision the RBA makes. But Fink's point is it takes away all that sort of emotional ups and downs that come with having an economy that's based on variable rate loans. And he says the variable rate loans can weigh on economic growth because when the rates are high or rising, everybody obviously is incentivized to stop spending, and that hurts the economy. Doesn't happen in the US, is his argument. You get this very steady state, you have certainty, and so people can do other things with their money. They can invest in shares, which helps grow the economy. They can invest in other things. There's a bit more dynamism. Now, is that because Americans are sort of more optimistic and more entrepreneurial? I don't know. Larry Fink probably tends to think so a little bit. But this is a really interesting idea because the reason we don't have 30-year fixed mortgages is sort of by a bit of a quirk of history. Alan Kohler's actually really good on this. You know, the US came out of the Depression and decided, hey, we want certainty. We're going to create the structure that allows for these 30-year fixed rate mortgages. Australia didn't go down that path. And what you need to back up these 30-year fixed rate mortgages is a big pool of liquidity, financial liquidity, to allow the banks to sell them. Now, the US government, they have government-owned agencies that provide that liquidity. Larry Fink's idea is that down here in Australia, we have a big pool of long-term savings called superannuation that would be perfect to backstop this market. So it's a really fascinating idea, Anthony. I mean, it would be a big shift, like a big historical shift. Think of the regulators, think of the legislation you'd need. Think of how the banks might react to this. Think of the consumers, what they'd do. But look, I reckon it's great to hear someone throw up a big idea. BlackRock's got a stake in that. They're actually creating a mortgage-backed security market in Saudi Arabia where home ownership's really low and they want to boost it. So guess what? Larry Fink would love to help us set this market up. So he's talking his own book a bit, but it's a big idea and yeah, great to hear someone suggest something different. But Anthony, can you see any holes in it? Any unintended consequences?
I guess the biggest advantage of our system, James, the way we think about it, the variable rate system, is just the way the cash rates are passed through. You know, if the economy is a bit heated, if inflation's too high, the RBA can increase rates, banks generally follow suit, and then within hours or days, you know, that's hitting people's mortgages. It's having a impact straight away, cooling down the economy. You know, we call that monetary policy transmission. We know how it works here. It's pretty quick. Banks are a big participant in this chain, James, and it only really works when they, you know, pass on rate rises or rate cuts. But we're seeing recently that they tend to be doing those. In the US, I mean, the transmission mechanism for when they have rate cuts, or rate increases, it's not about the impact on mortgages, James. It's all the other credit that they have in the system, and they have a lot more credit over there, a lot more personal loans, a lot more business credit, credit card loans, all that sort of stuff. So they get their transmission that way. Would we have enough credit in the system to get the transmission to do it without the mortgages? I'd question that, James. But I mean, in terms of other potential holes, number one is superannuation buying these products. I mean, we have $4.1 trillion superannuation pool, James. It is so powerful. It is so good. It's great. Do we need an American billionaire to tell us how to spend it? I don't know. But if you put that aside, but are there super funds looking to deploy so much money into what is an Australian exposure, housing? Yeah. I'm not sure. Everything I hear about them is they're trying to put money offshore at the moment. Number two, are the banks willing to cede the ground? Because this only works if the banks sort of give up mortgages, right, and hand them over to capital markets. Yes. So the banks wouldn't hold these mortgages on their balance sheet as assets. Well, that's what our banks are. That's their assets. The assets are the loans that they write to people. So they basically have to just write the loan and then offload that asset into capital markets. Do the banks want to cede that ground and be just like originators for loans rather than actual holders of them?
Probably not.
I reckon they'd hit the roof at first, but I mean, should they be the ones making the call? Probably not. I mean, other unintended consequences, I don't know what it would mean for house prices, James. My brain's not that big to work that out, but I think that's the number one thing you'd have to worry about.
Yeah, there is one interesting thing that's actually happening right now. So if you can imagine, because you can refinance these things, during the pandemic when interest rates went to zero, official interest rates went to almost zero in the US, lots of people, the majority of people, refinanced their 30-year fixed rate mortgage and locked it in at 2 or 3%. How much would you love to have a 30-year loan locked in at 2 to 3%? Yes, please. But the problem with that is that no one can move, because as soon as you do, you'll have to lock in a loan at a higher rate. That is a problem. It does have some unintended consequences for stock on the market. Yeah. So there's all these things that need to be thought through, and as you say, there's a lot of people that would need to, come on board to get such an idea going. But
now if you got a borrower paying 2 or 3% still on their mortgage, James, that means you've got an owner of those securities. In this case, it'd be a super fund that's receiving 2 or 3% a year. Yeah. How do you think Australian super is going to feel about that in this environment?
That's true, but I guess I would imagine that super funds would have bought some pretty low yielding securities back around that period anyway. I mean, they probably bought lots of US treasuries that were yielding, 2 or 3% at that time. So I think that can work itself out. I don't know. I guess the point Fink is trying to make, and you would probably agree with this, you're enmeshed in capital markets, Anthony. Australia has a really big banking system, but its capital markets are a lot shallower and a lot weaker than the US. If you could use superannuation to create a stronger capital market in Australia, that could be a real turbocharger for growth and prosperity, couldn't it? I mean, that's the idea here.
Yeah, absolutely. Yeah, I agree with that, James. Now tell us, so if it's such a good an idea, why do you think we haven't done this yet?
I think history. The super sector's still relatively young. It's 40 years old, and it's really only been ginormous for the last decade. So I think this is an idea that you could argue its moment wasn't possible till now. But yeah, I think the other thing is you just need, once a market gets set up in a certain way, change is hard for all of us, and a change like this would be pretty seismic, I think. So, but look, I don't know. Yeah, it's easy to shoot these big ideas down, but I like to hear someone come and not say the normal stuff, not give the normal platitudes about the super sector, and throw out a bit of a challenge to Australians. Say, hey, you could be doing heaps better. I like that.
Oh, 100%. Couldn't agree more. Now, James, tell us, what other pearls of wisdoms were there from Larry Fink?
Just one I thought was mentioning. We spoke a bit about Trump, and he's basically saying, look, this is all very dramatic, but it's not as exciting as you think it is, particularly if you're a long-term investor thinking about your retirement. 1, 2, 3, 4 years of any administration just doesn't matter. But the one thing he said on Trump and tariffs I thought was really interesting. He reckons Trump wants to make a deal with China, and China wants to make a deal with Trump, and he said that's great for Australia. If there is a trade deal, they can find common ground, work together on some things, compete on others. Australia's just perfectly placed. You've got a great trading partner and a great relationship with America. So I thought that was a pretty sort of positive note. His other thing, the solution to the housing crisis, he reckons, all over the world, fast trains. You need fast trains.
Fast
trains to be able to commute from outer regions into cities. If you make that commute fast and painless, then you can spread cities, you can access more lands, and it all becomes a bit easier. So that's another one, though, Anthony, that's easy to say and hard to do, right?
Great. It'd be so good to see it, James, but it sounds very expensive.
All right, we'll come back after the break and look ahead to the last week of reporting season and also a big report that could shake up Australian capital markets. Back in a sec. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Friday, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Okay, Anthony, reporting season continues. The last week, there's some seriously big companies. I reckon WiseTech, another sort of scandal hit company, is interesting. Qantas always gets a lot of attention. I think they're up on Thursday. Who are you looking forward to?
Oh, Woolworths and Coles, James. Always worth watching. I love the red versus green battle.
Yes, very true. We get another look at inflation on Wednesday when the monthly CPI indicator is out. Michelle Bullock and the team at the Reserve Bank will be watching that very closely. And I just wanted to flag on Wednesday, Anthony, ASIC's set to release a big report into the state of public and private markets. Should be really interesting. There's a lot of people around the market hanging out for this. They want to see where the regulator's landing on this big divide, and the lines are really being increasingly blurred between private and public.
They are, James, and ASIC's really talking tough on this private market side, which has never really looked that hard at in the past. But private markets are now getting so big, they feel like they've at least got to have a look and do this report, and it'll be interesting to see whether they sort of crack down on private market transactions and ownership and everything like they do in the public.
All right, well, we had a question earlier from Derek, but we'd love to hear some more questions. So if you want to send us a question, you can email us at chanticleer@afr.com. And of course, you can do as Derek did and send us in a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it through to us. Okay, Anthony, what a monster week. Take a breath and we'll go again next week. There's some big companies reporting and some more really seismic data to get our heads around.
Yeah, 1 week of results to go, James.
Fantastic. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald, and it was produced by Lapfan, Alex Gow, and Martin Peralta. Our theme is by Alex Gow, head of podcast is Lapfan, and the head of premium content is Fiona Buffini.
The Australian Financial Review.